You are comparing the performance against a classic 60-40 portfolio. I know you're not comparing it against the SPY total return because you consider that 60-40 better reflects what people have. True, like I just said previously, no rational investor can watch their net worth crash 50% and just go to sleep that night. It doesn't work that way. I know that if you look at a long-term chart, sometimes it appears like if we look at a long-term chart of the S&P 500, you might be tempted to think, oh, it's totally no problem. Like all I really have to do is just hang on for the ride, right? You might think, oh, well, this is crazy, but all I have to do is just hang on for the ride and I'll actually make my money back. But imagine what it's going to feel like in real time right there. And this is only a 34% drawdown. Imagine the 56% in the financial crisis. Imagine the 86% going back all the way to the Great Depression. I mean, long time ago, but you get the point. So no rational investor can hold the S&P total return. That's why when I'm showing my performance, I do like to show my performance against a 60-40. I think it's much more accurate to say, look, the vast majority of the investment world is in something that largely mirrors the performance of a 60-40. They might think it's complicated. Like you might think, oh, no, it's not true. I've got domestic and international stocks. I've got emerging markets and real estate and utilities, and I've got all these things, commodities. What you'll find is a lot of those things are highly correlated to a 60-40. So even though it sounds different and it looks more complicated, essentially the performance will track a 60-40. That's why I do it. The S&P, sure, it's as simple as just adding a line. But what I think a benchmark is legitimately giving people two choices. You can either do this or you can do this. That's what a benchmark is. And in my opinion, since nobody does the 100% stocks, why even show that, right? Why I'm trying to present my work, this is VTS. This is a 60-40 that 90% of the investment world follows. Which one do you want? You can do both. Which one do you want? It doesn't make a whole lot of sense to be showing somebody something that nobody should be doing that. You have no idea how bad the future is going to get, right? You're looking hindsight during a really long 12-year bull market. But look at the performance here, inflation adjusted of the three indexes. So we've got the Dow, the S&P, and the NASDAQ. Depending on the time frame, most people started investing here. So they think everything's fine. But what you're forgetting is it was only 20 years ago where the S&P 500 was in a inflation adjusted drawdown for 17 years. How would you feel if your net worth, first of all, drew down that much, like 60%, depending on which index you have, and then you had to wait 17 years to recover your money? Obviously, recency bias is making people think like, oh, this isn't that bad. Look, at COVID was terrible, but the market bounced the next month. I mean, we only had to wait until April, and all of a sudden the market is bouncing again. Well, I mean, slow down, people. That's not typically how the stock market works. The Fed had to spend $8 trillion to make that happen. The government had to do insane measures to make sure that that happened. Don't be so sure that we're not going to set up here for a 10 to 15 year drawdown in the stock market. Who knows? I personally don't think any rational investor makes that decision. Look, if you want to do it, I'm not the person to tell you you're wrong, but boy, I wouldn't wish that on my worst enemy. I don't have any enemies, but so like I said, I could add any benchmark you want to look at, that's fine, but it would be totally irrelevant because, I mean, who does that? It's crazy. And don't forget, again, we're going back in history. It's a long time ago, but after the 1929 Great Depression crash, the S&P 500 took 26 years to recover. It was in a drawdown for 26 years. That's pretty much an investing time horizon. That's way too long. And if you're approaching anything close to retirement, yeah, you're going to capitulate. You're going to do the absolute worst thing possible. You're going to ride it as low and as, until you just can't sleep anymore. And then you're going to sell. And that's what's going to happen. I would just recommend people know ahead of time, look, emotions during a drawdown is way more real and visceral than looking at it on a 20-year chart and saying, oh, I totally would have just held on and look at all that performance afterwards. Would you have? What if you have a wife and kids and you're down 50%? That's a little bit different than looking at a 20-year chart and saying, I would have held on. I don't think you would have. I don't think any rational investor would have.